She is a PhD candidate at the Polish Academy of Sciences. Ladies and gentlemen, please give a huge, very warm round of applause to Monika Swaczyna-Pruchnik.
All right. Good afternoon, ladies and gentlemen. I appreciate that this is almost the last session of the entire conference, so I understand the networking is more valuable than participating in panel presentations, so I appreciate that so many of you did come to listen to us. As already been mentioned, I'm currently pursuing my PhD degree in European Banking Union regulations, and during the course of my research, I have been studying the causes of the recent financial crisis and the root causes of it and possible consequences for the banking sector and what can be improved to not to facilitate and to avoid any future financial crisis. During the course of my research, I have came upon the concept and the idea and basically the problem if banks and if the financial sector is actually ethical. According to the Conduct Cost Project Research Foundation, between years 2012 and 2016, 20 largest banks globally that employ 2.3 million people and operate on a global level, that is population of 2.3 million people is the population of Lithuania, have actually been forced to pay fines for misconduct, redress, and mediation activities that equaled 300 billion Great British pounds, that equals 70% of the Polish GDP. So that is quite a significant amount, to be honest. To understand the root causes of such huge apparently problem and the causes and the scope of the last financial crisis, I started to ask the question, if this behavior is driven by individuals, or is this a problem sector-wide, or is this an organizational problem? Contrary to popular opinion, things that you see on the media, famous cases of prosecutions on individual fraudulent activities by bank employees, it's only 6% of cases of misconduct-related cases that were caused by individual wrongdoing. 85% of all cases related to misconduct were a result of mis-selling and mistreating customers. That proves that this problem is actually not an individual one, but it has its roots in how banks are organized. However, it's not only the problem of the banking sector per se. This is a problem of the entire economy, and not only of one country, but of the entire world. Around the world, in the years of 2012 and 2016, 50 million people were detrimented and impacted by the misconduct cases. Only in the UK, the 13 million people were detrimented in the PPI scandal alone. In order to understand what is the impact of this behavior on banks alone, one have to reach to the analysis and to the statistics. In the previously mentioned CCPRF Foundation report, it states that 10% of all costs incurred by banks in the given time were a result of misconduct behavior, and if the banks were not forced to pay those fines or costs of remediation and redress activities, their return of equity would be 3% point higher, and the profits there would have been 21% higher than they actually were. This does not include the reputational cost that is harder to measure, but according to Oxford Analytics, this might even equal to 9 times of this cost in lost income due to reputational reasons. One would argue that in current economy that is transparent and investors are smart and they take care of each other, the market would be able to value the ethics and the good conduct in financial institutions. However, the above-mentioned statistics and the research that I have conducted shows that this is not true. Unfortunately, markets and investors are prone to so-called short-termism, i.e. the instant gratification, and also something that my colleague previously mentioned. They prefer instant results, higher dividends, without thinking about the strategic and long-term results that, as it has already been proven on many occasions, ethical banks prove to be more profitable in the long term. There is no, as it's already been mentioned, there is no single definition of what exactly conduct and ethics is. So in order to measure it in the banking and financial sector alone, we have to take some approximation. In the UK, for a couple of years now, the Banking Standards Board has introduced a survey during which it questions and conducts interviews within the bank's employees and management boards and senior managers to understand what is the level of ethical behavior and what is the level of ethics and good conduct in this bank. However, the problem with this survey is that it's not legally binding and it's not being publicly disclosed. Therefore, it's only been circulated internally within the banks, within every single bank alone. So there is actually no external force that could force banks to implement new policies and new practices. Going from that, I argue that as I've already mentioned, markets cannot value the good ethics. The Banking Standard Board survey is not legally binding. There is a need of external regulatory intervention. The intervention could go both ways. It could be either positive, in a way of some kind of a stimulus, or a negative in form of the bank tax or levy that would be detrimental. However, the behavioral economics proves that people react better to positive stimulants, and that gives them something to pursue, not something to be afraid of. But for this positive stimulus to be efficient, it needs to be targeted as a specific group of stakeholders within the banking sector. Within the banking sector, we've got a couple of groups of relevant stakeholders. We start with the shareholders that exercise pressure on management board to get higher dividends and higher profits. The management board thus introduces policies and procedures that have to be followed by the managers and workers and employees by the banks. That affects how the clients are being treated and what is the level of the customer service. Therefore, as on top of this chain as our shareholders, my suggestion is that we should focus this regulatory stimulus on this particular group of stakeholders. For shareholders, the most important factor is the return of equity that we could divide into, that comprises of two parts. We've got net income that comprises of revenues, costs, loan impairment charges, corporate tax, and in some countries there's also a specific bank tax. And the second part is the capital that is being a responsibility of the regulator and the supervisor in any given country. And this is the part I think that would be most efficient, because this could prove that whenever banks are being forced to hold more capital or less capital, this acts as this positive stimulus. Otherwise, everything on the top of this slide acts as a negative: bank tax, corporate tax, and any given costs resulting from fines or some court legal rulings. However, in the light of the recent regulatory tsunami of the Basel II, III Capital Requirements Directive, people argue that banks are already encumbered heavily with the regulatory requirements. However, according to the research and to the data of Bank of International Settlements, Bank of England, International Monetary Funds, for average 30% that is already required for an average bank in any given country, and additionally 18% for the largest global banks, there's still something that gives room for improvement, but for the banks to still maintain the profitability. According to the IMF, capital requirements could be raised up to 18%, to Bank of England to the 19%, and to the Bank of International Settlements, there's still room for improvement, and there could be 20% capital requirements for all banks, but they could still be profitable. So to sum up, what I suggest to introduce is the regulatory stimulus that would be measuring the conduct and would be encouraging the good behavior and ethics in the banking sector. That would be, for every single bank in the given economy, an additional 1% of risk-weighted assets regulatory requirement. And based on the Banking Standards Board survey, but this one would be conducted on a biannual basis, and that would also include customers, not only employees and management board, but also customers, that would be conducted by the regulator and would be publicly disclosed. The regulator would be then dividing banks into 3 groups: ethical banks, normal banks, and non-ethical banks. And for the ethical banks, the regulatory requirement would be put down to 0. And for the non-ethical banks, the regulatory requirement would stay at this 1% of risk-weighted assets. Almost on time. Thank you very much. If anyone has any questions, I am available after the presentation. Thank you.
Fantastic. Thank you, Monica. That was wonderful. Used your time just to perfection. That was brilliant. So a very high standard from all of our nominees today.